Welcome to Trading to Rise. You know, every single day, there's a hidden game being played in the financial markets. It's a game of strategy, a game of hunting for orders, and a game where huge amounts of wealth change hands. Today, we're going to pull back the curtain on this secret game and show you exactly how it works.
Okay, so let's just dive right in with a big question. I want you to forget about your own trading for just a second. Imagine you're a fund manager and you need to buy or sell, say, $1 billion worth of stock. What do you think your single biggest problem is? I'll bet it's not what you think. So, to get our heads around their problem, let's paint a picture. Imagine you're a millionaire. All your wealth is tied up in assets. You got beautiful houses, fancy cars, a whole portfolio of stocks, but your bank account, it's empty. Now, all of a sudden, you need cash, and you need it fast. What do you sell? Well, selling a house takes months, but selling your stocks, you can do that in seconds.
Right, so this ability to quickly turn an asset into cash is called liquidity. It's probably the most important concept in the market. Stocks are super liquid, which is awesome for most of us. But here's the crazy part. When you're trading billions, that liquidity suddenly becomes your biggest nightmare. Why? Because if you try to sell a huge position all at once, you literally collapse the price before you could even get out.
To really see how this plays out, you first have to understand that the market is basically a battlefield with two very, very different kinds of players. Just think of it like a classic David versus Goliath story.
On one side, you've got us, the retail traders. We're the Davids, right? We're trading with our smaller accounts, and our biggest fight, it's usually in our own heads, managing fear, greed, trying to stick to the plan. But on the other side, you've got Goliath. This is the smart money. The giant banks, the massive hedge funds, their trades are enormous, and their biggest problem has nothing to do with emotion, it's just logistics. They simply have to find enough people willing to take the other side of their gigantic trades. It's a totally different world.
Come on, let's really put ourselves in their shoes for a second. Let's say you have to sell 1 million shares of a stock right now. If you just go and slam the sell button on a market order, you'd create this huge supply shock. The price would just nosedive as your order eats up all the buyers, and you'd end up selling most of your shares for a terrible, terrible price. You'd literally lose millions just in the process of getting out of the trade. So, what do?
Well, you definitely don't just dump your shares on the market. No way. Instead, you go on a hunt for liquidity. You have to be clever and find where the buy orders are already sitting there waiting for you.
Now, what's really fascinating about this is how smart money solves their problem. They go and find places where thousands of our retail orders are already bunched up together. They don't have to create demand out of thin air. They just need to go where it already exists in these nice concentrated pools.
So, where are these pools? Well, they come in two main forms. First, you got stop-loss orders. These are the orders we all place to protect ourselves if a trade goes against us. Second, you have limit orders, the ones placed by traders who are waiting to buy or sell at a specific, better price. And here's the kicker. Both of these order types tend to cluster at really obvious, really predictable technical levels. You know, like old highs and old lows.
This brings us to a really, really critical shift in how you see the market. The game isn't actually smart money versus retail. The real battle is between one giant institution and another. Retail traders, we're not the main opponent. We are simply the resource. We are the fuel they need to pull off their massive trades against each other.
Okay, so how in the world do they use our orders as fuel? It's simple, really. They engineer a trap. It's a maneuver specifically designed to trigger our stops. So let's break down exactly how this liquidity hunt actually works.
Let's walk through this trap step by step. First, a really obvious predictable pattern forms on the chart, like a super clear high. Second, retail traders see this pattern and they jump in, feeling confident. Third, they do exactly what every trading book tells them to do. They place their stop-loss orders all together in the most obvious spot, right above that high. And now the trap is set. Fourth, smart money steps in and deliberately pushes the price just high enough to poke through that level. Fifth, this triggers that massive cluster of stop-losses, which creates a sudden, huge flood of market orders. And finally, the sixth and most important step, smart money uses that flood of sell orders to fill their own massive buy positions. Once they're done, the pressure they created just vanishes and the price reverses hard, leaving everyone else trapped on the wrong side of the market.
So, if this is happening all the time, how do we avoid these traps? Well, the secret is to stop looking at the market from our perspective and start looking at it from theirs. And that means we need to zoom out.
Think about it this way. If I asked you to sell 100 cars, would you have a better shot at getting a good price if I gave you 30 minutes or if I gave you 6 months? Of course, with 6 months, you can wait for the right buyers and get the best price. It's the same for smart money. They need time to fill their billion-dollar orders, which means they operate on much higher time frames, like the daily or the weekly charts.
This is so important to understand. The 5-minute chart, that's our playground. That's where we retail traders play. And the liquidity there is kind of like a shallow puddle. It's easy to splash around in and manipulate. But the daily and weekly charts, man, that's where the big institutions live. The liquidity there is like a deep ocean. The support and resistance zones on these higher time frames are way more significant because that's where the really massive orders are resting.
So let's just summarize the crucial takeaways here. First, the market isn't random, it's a constant, deliberate search for liquidity. Second, those clean, obvious levels you see on your chart, they're not safe zones, they are hunting grounds. Third, the entire strategy of smart money depends on us, the retail traders, behaving in predictable ways. So when you see a sharp, violent reversal from a key level, you gotta understand it was probably an engineered hunt. Your new edge comes from asking one simple question before every trade. Where is the most obvious place for everyone else to put their stops? Because that is the target.
So I'm going to leave you with this one thought. The next time you're looking at a chart and you see the price spike right through a key level only to immediately reverse and go the other way, what are you going to see? Are you going to see random, chaotic noise? Or are you going to see the footprint of a giant, a carefully planned, deliberate hunt for liquidity?
Your job now is to take this new perspective and actually apply it. In your very next trading session, I want you to stop just looking for patterns. Start looking for the pools of liquidity. Ask yourself, okay, if I were a typical retail trader entering right here, where would my stop loss be? Because that is where the real action is going to happen.
If you want to dive even deeper into this and learn specific strategies for how to trade with smart money instead of becoming their fuel, make sure you subscribe to Trading to Rise. In our next episode, we're going to show you exactly how to identify the footprints they leave behind on the chart. You don't want to miss it.